You ever stop and ask yourself why your rent keeps going up, why your paycheck buys less, and why every politician keeps saying the economy is strong while you feel broke? It's because the very foundation of the money you use, the US dollar, isn't money in the way you think it is. It's a liability, a debt token. Every single dollar in circulation started its life not as wealth, but as someone's IOU. And here's the twist no one likes to think about. When the Federal Reserve creates new dollars, there's no lender behind it. There's no pile of savings, no vault of gold, no stack of bonds they cashed in. They just type numbers into an account and call it liquidity. They're not lending money they have. They're creating money that didn't exist 1 second ago. So when you ask who's the lender, the answer breaks your brain a little, because there isn't one. The Federal Reserve lends money into existence, charges interest on it, and somehow we all end up owing them for money they never actually possessed. Here's where things get insane. As of 2025, the Federal Reserve's balance sheet is still hovering around $7.2 trillion, down from its pandemic peak of $9 trillion. But that's still triple what it was in 2008 before the financial crisis. About $4.9 trillion of that is in U.S. Treasury securities, the debt of the federal government. Another $2.3 trillion is in mortgage-backed securities, home loans bundled up and sold by banks that the Fed bought to support the housing market. So, think about that. The Fed holds your government's debt and your mortgage debt. They collect interest on both. And how did they pay for those assets? They didn't sell anything. They didn't earn that cash. They didn't tax you. They created it, out of nothing, with a few keystrokes at the Federal Reserve Bank of New York. And every time they do, your dollar loses a tiny fraction of its value, because the more dollars they create, the less each dollar is worth. Most people think inflation is caused by greedy companies or supply chain shocks. That's part of it, sure, but that's like blaming the fire on the smoke. The root cause of inflation is monetary expansion. Too many dollars chasing the same number of goods. Between 2020 and 2022, the Federal Reserve created about $6 trillion in new base money. That's a 40% increase in the total U.S. money supply in just 24 months, the fastest monetary expansion in American history. And people wonder why eggs cost $6 a dozen in 2023. That wasn't corporate greed. That was arithmetic. The Fed's balance sheet tripled, the money supply exploded, and your purchasing power evaporated. Every new dollar created by the Fed is a silent tax on everyone holding old dollars, and that tax is called inflation. But here's the part that gets really dark. When the Fed creates money, it doesn't give it to you. It gives it to banks. The dollars appear as reserves in the banking system, credits that commercial banks can use to make loans or buy assets. In other words, when the Fed prints, JP Morgan and Goldman Sachs get first dibs. You get the leftovers, diluted dollars, higher prices, and debt. This is what economists call the cantillon effect, named after the 18th century economist Richard Cantillon. The people closest to the money printer benefit the most because they get to spend the new money before prices rise. The rest of us get stuck with inflated costs after the money has already been absorbed into the system. The Fed doesn't lend to you, it lends to banks. The banks lend to the government, to corporations, and to you, at interest. The Fed creates the dollars, but the debt lands in your lap. And remember, the Fed isn't some neutral government agency doing this for the public good. It's a network of 12 regional banks, each technically a private corporation with shareholders. The Federal Reserve Bank of New York is the most powerful, and its largest shareholders are, surprise, JP Morgan Chase, Citigroup, Bank of America, and Goldman Sachs. These are the same institutions that collapsed the global economy in 2008 and got bailed out with trillions of dollars. They literally own stock in the institution that creates the nation's money supply. Each regional bank is required by law to pay its member banks an annual 6% dividend on their shares, risk-free, guaranteed, no matter what happens in the economy. So yes, while you worry about losing your job in a recession, the banks that own the Fed get a legally mandated payout, even if they helped cause that recession in the first place. That's not capitalism, that's feudalism in a suit. Let's get something straight. The Federal Reserve doesn't owe anyone, because it doesn't borrow, it creates. But the U.S. Treasury owes the Federal Reserve, because every dollar the Fed creates is created by buying Treasury debt. The government issues bonds, IOUs, and the Fed buys them with freshly created dollars. Then the Treasury owes the Fed principal and interest on those bonds. The government collects taxes from you to pay that interest. So your taxes don't fund schools or roads as much as you think. A huge chunk, over $1 trillion per year as of 2025, goes toward interest on the national debt. And about $100 billion of that interest goes directly to the Federal Reserve System itself, which then pays dividends to its member banks. The banks get paid interest on money created out of thin air, backed by your labor and your taxes. That's the invisible debt machine, and it runs 24/7, humming quietly behind the headlines. Here's what almost no one outside of Wall Street understands. The Federal Reserve now pays interest to banks, not for lending, but for doing absolutely nothing. After the 2008 crisis, the Fed started paying interest on reserves, IOR. Basically, every dollar a commercial bank keeps parked at the Fed earns a guaranteed return. As of 2025, that interest rate sits at about 5.25%, the highest in over 2 decades. There's currently over $3.4 trillion in excess reserves sitting in those Fed accounts. Idle money the banks aren't lending out, just collecting interest on. Do the math. That's about $178 billion per year in free, risk-free income paid to private banks directly from the Federal Reserve, which creates that money out of thin air. Where does that interest come from? You guessed it. The Fed creates more money to pay it, which adds to inflation, which erodes your purchasing power, which forces the Fed to raise rates again, which increases what it owes to banks. It's a perfect feedback loop, a perpetual motion machine of wealth extraction. There's also the reverse repo facility, the place where money market funds, investment firms, and big banks park cash overnight with the Fed. In 2022, that pool peaked at $2.5 trillion. By late 2025, it's fallen to about $700 billion. But still, that's $700 billion earning daily interest from the central bank, roughly 5.3% annualized. The Fed pays out over $35 billion per year just to keep that cash sitting still. Think about that. They are literally paying the biggest financial players in the world tens of billions of dollars for the privilege of holding risk-free cash they created. You don't get that deal on your savings account. When you deposit money, your bank pays you 0.01% and lends your money out 10 times over. But when banks deposit their money at the Fed, they get a guaranteed 5% yield. That's not a free market, that's a rigged casino where the house always wins, and you're just lucky if they let you play at all. So who's the lender here? The banks? The Fed? The answer is, the entire system is a circular pyramid of IOUs where everyone owes someone, except the Fed itself. The Treasury owes the Fed. The banks owe the Treasury. You owe the banks. And the Fed owes nobody, because it creates the money that everyone else owes. This is the part most economists avoid saying out loud. The Federal Reserve is not a lender of last resort, it's a lender of first creation. It's the fountainhead. It loans existence to dollars. Without its debt, the dollar literally wouldn't exist. But that comes with a cost, because every dollar is born as debt. The system requires perpetual interest payments. And because interest isn't created when the loan is, there is never enough money in circulation to pay it all back. Someone always has to default, or new debt must be created to pay old debt. That's why the U.S. national debt never shrinks. It can't. It's mathematically impossible. As of November 2025, the U.S. national debt has crossed $36.7 trillion, up $2.4 trillion in a single year. Interest costs alone have skyrocketed past $1.15 trillion annually. Now the single largest line item in the federal budget, more than defense, more than Social Security. And while politicians scream about deficits, nobody talks about who that interest money goes to. It doesn't vanish into space. It flows to bondholders, and the single largest holder of U.S. Treasuries is the Federal Reserve. The Fed owns nearly $4.9 trillion in government debt. So the U.S. government borrows money from the Fed, pays interest on that debt, and the Fed uses that interest to pay private banks their guaranteed 6% dividends. It's the cleanest loop of wealth extraction in human history. Taxpayers fund the interest, the Fed collects it, banks receive dividends, and politicians pretend it's monetary policy. You want to see the scam in action? Look at what happened between 2021 and 2024. When the Fed raised interest rates from near zero to over 5%, they started losing money. Yes, the Federal Reserve itself began reporting operating losses for the first time in modern history. How is that possible? Because they were paying out more interest on reserves and reverse repos than they were earning from their bond portfolio, which was locked in at lower yields. By 2024, the Fed's cumulative losses exceeded $130 billion, and instead of covering those losses like a normal company would, they created a new accounting trick called a deferred asset. It's bureaucratic wizardry. They just declared that future profits will make up the losses, so they don't count as losses today. Only a central bank could lose $130 billion and call it an asset. You can't make this up. Imagine if you lost your paycheck gambling and just told your bank, "Don't worry, future me will pay it back." That's the Federal Reserve's entire business model. But don't think the Fed's losing sleep, because every dollar of those losses represents billions paid to commercial banks and money funds, the very institutions that own and control the system. When JP Morgan collects $10 billion in interest on reserves, that's counted as a Fed loss, but it's JP Morgan's profit. So the Fed's losses are actually just wealth transfers disguised as accounting adjustments. The Fed isn't supposed to make a profit. Its real job is to make sure you don't. Because every dollar you earn loses value as more dollars are created. The moment they expanded the money supply to rescue the economy, they guaranteed inflation. And when inflation hit, they raised rates to fight it, which increased the government's interest burden, which required more borrowing, which increased the debt, which made future inflation inevitable. It's not policy, it's dependency. Here's the paradox no one on CNBC will say. The Federal Reserve's balance sheet isn't just a list of assets. It's a map of ownership. Every treasury bond, every mortgage-backed security on that sheet represents a claim on real wealth, your taxes, your property, your labor. The Fed holds claims on trillions of dollars worth of American productivity, and it didn't have to lift a finger to get it. It didn't produce anything. It didn't invent anything. It didn't even risk anything. It just printed the money and let compound interest do the rest. This is why the question, who's the lender, is so dangerous, because once you realize that there is no real lender, you realize that the system's debt isn't owed to someone, it's owed to the system itself, a machine that feeds on perpetual obligation. Let's rewind for a second, because to really understand how the Federal Reserve became this untouchable money god, you have to know where it came from. Not from Congress, not from the Constitution, but from a secret meeting in November 1910 on an island off the coast of Georgia. 7 men, representing roughly 1/4 of the world's total wealth at the time, snuck onto Jekyll Island under fake names to design what would become the Federal Reserve System. These men weren't economists or civil servants. They were bankers. Paul Warburg of Kuhn, Loeb and Company, who had deep ties to the Rothschild banking dynasty, Frank Vanderlip of National City Bank, which later became Citigroup, Henry Davison and Charles Norton of JP Morgan and Company, and Benjamin Strong, who would later become the first president of the Federal Reserve Bank of New York. Their mission? To create a central bank that looked federal enough to satisfy the public, but private enough to protect Wall Street's control of the money supply. When the Federal Reserve Act passed in 1913, they got everything they wanted. Congress thought it was delegating monetary management to a neutral public agency. What it really did was hand over the printing press to the same private banks it was supposed to regulate. Now fast forward a century. The same structure still exists. 12 regional banks, privately owned, and a central board of governors that gives the illusion of oversight. But the real power sits where it always has: New York. The Federal Reserve Bank of New York executes the trades, manages the U.S. government's account, and literally controls the flow of digital dollars through the global system. It's the heart of what insiders call the plumbing of the financial world, the electronic infrastructure that clears trillions in transactions every day. This is where the modern trick gets even more sophisticated. In 2023, the Fed launched FedNow, a real-time payments network advertised as a way to make instant bank transfers. What they didn't emphasize is that FedNow gives the Federal Reserve direct oversight over every participating bank's payment activity, the ability to see and eventually control every dollar that moves through the system in real time. It's not technically a central bank digital currency yet, but it's the skeleton of one. And make no mistake, a digital dollar is coming. The groundwork is already there. The Treasury and the Fed have run multiple pilot programs with commercial banks to test tokenized deposits and blockchain-based settlement systems. In 2024, the New York Innovation Center, working with the Bank for International Settlements, completed a project called Project Cedar, which proved that wholesale dollar transfers between banks could be executed in seconds using distributed ledger technology, a fancy term for centralized blockchain controlled by the Fed. They're not doing this for convenience. They're doing it for control. Once dollars exist only as programmable code on a Federal Reserve ledger, cash becomes obsolete. Every transaction can be traced, taxed, frozen, or reversed. If the Fed can see your balance in real time, it can also decide where you can spend, how much, and on what. Don't believe it? Look at China's digital yuan, programmable money that expires if not spent, and can be turned off for citizens with low social credit scores. Western central banks aren't copying the idea for fun. They're preparing the same framework but wrapped in the language of efficiency and innovation. But let's connect the dots. Why would the same institutions that profit from the current system, the big banks, support a digital dollar that could in theory bypass them? Because they won't be bypassed. They'll administer it. Under every central bank digital currency proposal, private banks remain the front end, the customer interface. You'd still have your account at Chase or Wells Fargo, but that account would sit on a ledger directly controlled by the Federal Reserve. Banks would become fee-collecting intermediaries, no longer constrained by reserves or deposits, because the Fed would provide unlimited liquidity in real time. And since the Fed already pays them interest on reserves, they'd just earn more by managing digital flow. It's the same debt system, just faster, deeper, and with zero privacy. The next phase isn't about printing money. It's about programming it. This new architecture will make the question, who's the lender, even more meaningless, because there won't be a transaction that isn't originated, settled, or recorded by the central bank itself. When money becomes code, the issuer isn't just a lender, it's a gatekeeper. The Fed could set negative interest rates directly on digital balances. It could prevent hoarding by making dollars expire after a year. It could even airdrop stimulus into accounts instantly, but only for people who meet certain criteria. That's not hypothetical. Those features already exist in digital currency prototypes. The Boston Fed ran tests with MIT's Digital Currency Initiative exploring programmable monetary policy, their own words. And who do you think will decide the code? Congress? The people? No. The same unelected technocrats who decided in 2020 to conjure $6 trillion from nothing and give most of it to the banking system. Meanwhile, the concentration of wealth continues to accelerate. The top 1% of Americans now hold over 30% of all household wealth, the highest share in modern history. The bottom 50% own barely 2.5%. Every time the Fed expands its balance sheet, the asset holders, the ones with stocks, real estate, and bonds, see their portfolios inflate. Everyone else just sees higher prices. Between 2020 and 24, U.S. household net worth increased by $34 trillion, but 70% of that went to the top 10%. The Fed's quantitative easing didn't just stabilize markets, it institutionalized inequality. And with a digital dollar, that inequality becomes programmable too. Interest rates, lending access, and credit scores could be adjusted algorithmically. Imagine an economy where your access to money depends on your behavior, your purchases, or your carbon score. That's not a conspiracy theory anymore. That's a policy proposal in several Western central banks. The ultimate irony? While Americans argue about politics, inflation, and who to blame, the real power quietly consolidates in the hands of the same cartel that was born on Jekyll Island 115 years ago. The names changed: J.P. Morgan, Citi, Goldman, but the structure didn't. The Federal Reserve doesn't need to own everything outright, it just needs everyone to owe it. That's the essence of control. When you ask, who's the lender, in a digital dollar future, the answer will be the system itself. The code will be the creditor, and the rest of us will just be variables in its balance sheet. Here's the uncomfortable truth almost nobody wants to say out loud. The Federal Reserve isn't just America's central bank anymore. It's the control room for a global debt empire, and the rest of the world runs on its oxygen. The U.S. dollar isn't just a currency, it's the foundation of international credit, the unit every other central bank measures against, the settlement layer for global trade. When the Fed prints, the entire planet feels it. About 60% of the world's foreign exchange reserves and nearly 90% of all foreign exchange transactions involve dollars. That means when the Fed expands its balance sheet, it's not just inflating the American economy, it's inflating the world. And every dollar created out of thin air in Washington becomes a chain around the neck of every nation that borrows in that currency. Because debt denominated in dollars can only be repaid in dollars. And the only place new dollars come from is, you guessed it, the Federal Reserve. That's the dirty secret behind the strong dollar policy. When the Fed raises rates, it doesn't just slow down American inflation, it drains liquidity from the world. In 2022-2023, when the Fed hiked aggressively to fight the inflation it had caused, the dollar surged. Developing countries saw their currencies collapse. Nations like Egypt, Pakistan, and Argentina watched their foreign debt service costs explode because their loans were in dollars. In effect, The Fed exported deflation abroad and imported stability at home. Meanwhile, the IMF, the International Monetary Fund, stepped in with rescue loans, which of course came with strings: austerity, privatization, and policy alignment with Western financial interests. That's the modern version of colonialism. The Fed controls the spigot. The IMF enforces the rules. Together, they make sure the global economy runs on debt, and that debt runs on dollars. And behind it all sits the Bank for International Settlements in Basel, Switzerland, the so-called central bank of central banks. It's where the Federal Reserve coordinates with the European Central Bank, the Bank of England, and the Bank of Japan. It's where monetary policy becomes international law without a single democratic vote. The BIS isn't a conspiracy. It's a legal entity with its own immunity, its own police-free zone, its own tax-exempt status. Founded in 1930 to manage World War I reparations, it evolved into the quiet nerve center of global finance. When you hear about coordinated central bank actions, that means the BIS has given the nod. When the Fed opens dollar swap lines, emergency pipelines of liquidity to foreign central banks, it's extending the reach of the dollar system. In March 2020, as markets collapsed, the Fed opened unlimited swap lines with the ECB, Bank of Japan, Bank of England, Bank of Canada, and Swiss National Bank. In total, over $450 billion in emergency dollar liquidity was pumped into foreign banks within weeks. It was called a rescue. But what it really was a reminder. The world runs on dollars, and the Fed controls the tap. Every time a global crisis hits, 2008, 2020, 23, the solution is always the same: print more. And every new round of printing makes the system more dependent on the next one. It's financial heroin. When rates are low and liquidity is endless, corporations gorge on debt to buy back stock, governments borrow to fund promises, consumers max out credit to keep up. Then, when inflation inevitably spikes, the Fed raises rates and everything starts breaking. Banks collapse, markets freeze, and currencies crumble. So the Fed steps back in with bailouts and liquidity injections. That's not a bug. It's the cycle. Expand, contract, repeat. Each cycle transfers more real assets, property, businesses, land, from the public to the financial elite. It's not just monetary policy. It's a conveyor belt of ownership. In 2008, total global debt was about $173 trillion. By 2025, it's over $315 trillion. That's 330% of global GDP. Think about that. For every dollar of goods and services produced worldwide, there are $3.30 of debt attached to it. And because every dollar of debt carries interest, the global economy must keep growing just to avoid collapse. That's why infinite growth is baked into every political promise. But infinite growth on a finite planet is a mathematical impossibility. The debt system doesn't care. It doesn't need the real world to grow, just the numbers. Every new dollar the Fed creates feeds the illusion a little longer. But when the interest burden exceeds the productive capacity of the system, when the real economy can't service the fake one, something breaks. That's what 2020 was, the first global liquidity seizure of the 21st century. The Fed papered it over with $6 trillion. But the next one will require tens of trillions, and digital currency will be the mechanism. The digital dollar isn't just about faster payments. It's the ultimate backstop for a system that can't survive without constant expansion. When the next crisis hits, the Fed won't send stimulus checks by mail. It'll deposit programmable credits directly into every citizen's Fed-linked wallet. The code will dictate what you can spend it on, how fast, and maybe even whether you're eligible based on your carbon footprint or tax compliance. The Treasury won't issue bonds. It'll issue digital liabilities. And the line between fiscal and monetary policy between government and central bank will vanish. When that happens, there won't be a lender anymore, because the very act of creating money will be identical to creating debt. The Fed will be both creditor and debtor, controller and enforcer, the origin and the end of every transaction. When everything is debt, ownership becomes meaningless. Your house, your car, your savings, they're all claims denominated in dollars, and those dollars are claims on more debt. The entire system is a recursive mirror: money backed by debt backed by promises backed by confidence, and confidence backed by nothing but inertia. The moment people stop believing the system can sustain itself, the illusion cracks. That's why the Fed's real power isn't in its balance sheet, it's in psychology. As long as people believe the dollar has value, it does. But that faith can evaporate in a week. Ask Argentina. Ask Weimar Germany. Ask anyone who's lived through hyperinflation. The Federal Reserve's real job is managing belief. Belief that this mountain of IOUs can stand forever. But it can't. And deep down, the architects of the system know it. That's why they're racing to digitize it. Because when confidence falters, speed becomes survival. A digital monetary system allows total, instantaneous control over liquidity. It means when panic hits, they can lock withdrawals, freeze transfers, impose temporary capital controls. It means they can delete debt or create credit with a line of code. It means the next bailout won't need Congress, it'll be automatic, and that's the endgame of infinite debt. A self-regulating digital matrix where every dollar, every loan, every life is just data in the Fed's machine. So when you ask when the Fed creates dollars out of thin air, who's the lender? The final answer is brutally simple. There isn't one anymore. The system itself is the lender, the borrower, and the collector. The Fed doesn't owe anyone, because the Fed is the balance sheet of the modern world. But everyone, governments, corporations, citizens owe the system. That's the trap. A century ago, they built it on paper. Today, they're rebuilding it in code. And once it's complete, money won't just be debt, it'll be data. And whoever controls the data will control everything.